selling real estate, cryptos, or selling stocks, they are all considered as capital gains.
This is actually the best time to be talking to your CPA now.
For every $1 of expense we identify, normally you save around 47 cents in taxes.
You really have to educate yourself. You can't just blindly trust your CPA team. The IRS wants to incentivize people to invest a certain way, and it's legal, right? We're not saying anybody to do anything illegal here. Do things smartly, but at the end of the day, that's why you need to have a CPA that's confident is going to stand behind you if these things are called into question. All right. Welcome, folks. We have Arvi from the CPA team to answer tax questions. We'll start off with some basics here just so that everybody's caught up to speed. And then if you guys have any questions, type it into the chat box. On the left side, you have ordinary income. We don't like that because you pay all these taxes on it. This is where you get from a W-2 or a 1099. We like passive income. Not only is it passive, but that color of money comes from rent, syndication deals, non-portfolio investments. But the cool thing is we can use the passive activity losses or depreciation from real estate to knock that passive income out. So again, you can use these passive losses, or what we're called PALs, to knock out passive income and thus lowering our adjusted gross income that way. This is really important if you're in the higher tax brackets, even in the 22% range. If you can knock out your passive income, that can drastically decrease your taxes. But there's a wall here. You can't use the passive losses to offset ordinary income. There's a wall here unless you have real estate professional status. Just starting out, Arvid, did I get it right?
Lane is right. A little reminder here on the ordinary income, because on the finance side of things, dividends and interest are considered passive on the finance industry, right? However, per IRS, they still consider it as ordinary income or active income. It's not classified under the passive income. Also, there's another type of income that you cannot mix with either passive income or ordinary loss and passive loss, which is the capital gain. So it's capital gain, passive income, and ordinary income or active income. You cannot mix.
I've heard of this thing called portfolio income, right? Coming from selling some stocks, certainly selling crypto. Is that portfolio?
Yes, correct. Dividends income, interest income, they are on the active income side of things. But when you sell like stocks or cryptos, they are on the capital gains side. There should be another one like capital gains, passive income, and then ordinary income.
Maybe talk to us a little bit about when you sell crypto or sell a stock, that kind of capital gain versus selling a piece of real estate that you've owned for more than a year and less than a year.
Actually, selling real estate and selling cryptos or selling stocks, they are all considered as capital gains. Now, when you're selling real estate, just be careful how much is your capital gain. If you've used depreciation all throughout before you sold it, some of those are what they call recaptured depreciation, which has a different tax rate. So on the capital gain side, it can be a mixture of an ordinary depreciation and capital gains, right? That's if you sell the real estate, if you sell stock, and if you sell cryptocurrency. However, any income that you've generated out of the rental properties or any losses, that's the time that it's considered as either passive income and loss. So you cannot mix the passive loss or passive income that you've generated because you hold the property, you have not sold it yet. So you cannot mix those income and losses coming out of the rental properties to your ordinary income or capital gains income or loss. So if you invested in syndications or if you hold a lot of real rental properties, this is the best time to coordinate with your CPA because you might be surprised when you say, hey, I've invested here or I've renovated a property or I got a big recap from Lane's investment. You will not be able to use those losses if majority of your income is composed of either the ordinary income or capital gains income.
This is actually the best time to be talking to your CPA now because they've come from their tax filing coma in October and they're back and their brains are working really right now.
It's not their tax planning season.
Yeah.
Can you distinguish between qualified dividends and non-qualified dividends?
Qualified dividends. So if you hold the stocks of a C corporation for more than a year, that's the time that it is classified as qualified dividends, which is taxed at a 20% rate. But if you held the stocks for less than a year, that's the time that it's an ordinary dividends, which is taxed at your ordinary bracket.
Okay. And then the capital gains is going to be taxed here at the capital gains tax rate, long-term.
First things first, we need to separate the capital gains, whether it's long term or short term. If it's short term, it will be taxed at your ordinary bracket. If it's long term, we need to see what's your income if you combine the ordinary income and passive income. If it exceeds a certain, let's say you're single and your income without considering capital gains is below 44,000, that the long-term capital gains will be taxed at 0%. If your income without considering the capital gains is between 44,000 to 492,000, the long-term capital gains will be taxed at 15%. And if, let's say, you're single and your other income is beyond 492,000, the capital gains will be taxed at 20%, which is why if our clients has a big exit or if you sold a big amount of capital gains, the first thing that we do is we try to reduce their ordinary income and passive income by accelerating the depreciation of rental properties or identifying side hustles to help you generate some losses. So that we'll try our best to at least sneak you in on that below 44,000 income, which will give you a 0% tax on your capital gain. Then after that, let's say we've already utilized all strategies and still you are at the higher bracket, then we figure out a way to defer your capital gain by investing in, let's say, qualified opportunity zone business, or let's say moving the stock into an global trust so that it will be taxed.
Because the use case is if you're looking to sell a real estate asset or any asset over a couple $100,000, that's when these tax strategies come into play. You not only have to think about where you are in terms of the tax brackets, but also the long-term capital gains. These two charts are really the only ones I look at.
A little bit more about the suspended passive losses. Those are just passive. If you're not a real estate professional, I get these big depreciation on an asset. Later, when it goes to sell, I can't use any of that against it. I end up with this capital gains. I've got $300,000 now of suspended passive losses. If you're not a real estate professional, when am I going to get to use these suspended passive losses? I'm just wondering what other ways I can use the suspended passive losses in my planning.
Unfortunately, we need to wait for other passive income to use it right now because technically we cannot switch on with the other types of income.
Now, what about a passive investor in a business?
Passive investor with a business.
Yeah. If you managed it less than 15 hours a week?
Yeah. If it's possible, right? Let's say you are an owner of an S corporation with big amounts of income. That year might be the best for you to be classified as a passive investor. In that way, the income of that S corporation can offset your passive losses out of that business income. But you need to classify yourself as a passive owner of that business.
So here's a scenario. Let's say I have a business that I've had for 4 years. I make $1 million each year, and I'm gaining some passive losses throughout those 4 years through real estate, whatever. And then the 5th year, I'm like, hey, I now have built the business enough to where I can go work 10 hours a week on this business, class myself as a passive investor. The last 4 years with those passive losses, would that help me in that 5th year?
Yes, it will. However, just a question. Is it a C corporation or a pass-through?
S corporation?
S corporation, yeah. Just make sure to classify yourself as a passive owner.
And is that a calendar year you would have to have less than, 500 hours, something like that? You just have to make sure you're less than that amount of hours over that.
Correct. Or if you have your own manager out of that business, you could prove, hey, I spent 500 hours, but compared to the other C-level employees, they spent more than me. So that will also qualify you as passive owner.
Does it matter? So it has nothing to do with your operating agreement.
Technically, no. At
Actually-
the end of the day, it's the intention or what
Yeah.
type of owner you are at the end of the year.
Would he need a logbook to validate his hours or lack thereof of billable hours? Then
No, but with my other clients, it's a big S corp or a C corporation. I check their timesheet they're locked in. And then from there, we try to at least compare it with material participation test.
Yeah. Say a dentist has 4 other dentists working under them.
But most of the time, if you already have your own general manager who's handling the operations of the business and you're just part of the board or you're just on the high level management of things, you're not involved on the day-to-day operations, that would be enough. That's your passive owner.
Technically, you still have to be under that 15 hours a week.
Even
Okay.
if you spend more than 15 hours compared to other C-level positions where they're spending a lot of time managing the business, you could use that as proof. It's actually under the material participation test of the IRS, where if you can prove that the hours that you spent is way lower compared to the others, then you're not materially participating, or vice versa. You can prove that, let's say you spend 15 hours, but the other managers are only spending, let's say, 2 hours per day, then that's also proof that you are still materially participating under the.
I guess maybe just to summarize it for other people, he has all these passive losses, but he can't use the things unless he becomes a real estate professional status person, which I think we'll go into that topic after. But another way of doing this is we'll change the color of your income to passive income. You own the business, but you're trying to step back in terms of what you work so that you can change that color of money, not from ordinary or active income to passive income. So you can, if you were in a situation, you can use all these passive losses to extinguish that passive income.
He can still use those losses for the exact deal, right? So you had all this depreciation from a specific syndication that you didn't get to use. When that syndication sells, even though it's a capital gain, you get to use those losses. So you can still use them
Just not this year. You need to wait.
until it sells.
But I had that situation, and that's why I'm asking, because we're sold this year. I had depreciation, but it was capital gain. Do I need to specifically mention that and go, hey, this is something I already took depreciation on? I thought the K1 shows that. I still don't totally understand K1s. I just want to make sure that totally works for me. If I take depreciation on investment and then years later it sells, I'm happy to recapture it. I just feel like it goes into this pot that I haven't quite been able to tap specifically. Sorry.
Sure. You just need to inform your CPA, or you need to inform us, because that K1 does not present like the accumulated losses unless they provide supplemental info on it.
Yeah, of course. Provide, maybe say we bought it in 2019 and we did all the depreciation that year. If I send that K1 over,
Yeah.
that's enough.
Correct.
Okay, great. Because that's where I was feeling frustrated.
When you're transferring to a CPA, the form that they will give is like the normal form, but they do not give the carryovers or depreciation schedules unless you request it specifically.
Okay.
That was the problem, right? If it's not on your 8582 form that was carried on some years past, it's almost like you've lost hundreds of thousands of dollars. It's almost like he lost 150 grand.
Yeah, I mean, it's somewhere. That K1 tracker that you sent out before, Lane, I've tried to use that and keep its cost basis. But I'll be honest, it's a little confusing because every K1 is slightly structured differently, I find. And some have losses and gains in a different section. Some call it rental income. Some call it a different kind of income. I think it's good to remind the CPA because maybe your CPA is new since that happened, right?
Isn't that part of the filing for the CPAs? Each deal has its own log sheet of what it's accumulated year to year. Doesn't everybody do that?
It's part of the filing. However, when you transition to a new CPA, it's not part of the basic document they usually send to the next CPA unless you inform them specifically.
Okay. So you didn't get the archives or the history. So he's basically started at zero with them. Oh, is that something he can do an amendment on to capture that back?
Yes, definitely.
Okay. That's
Or
great.
normally on this year's filing, if we will not utilize it anyway, I'll just include it as the additional. This is the carryover losses as of date.
Because what's confusing for me is, so they take this depreciation in 2019 of say $20,000, but then now they go to sell it. And let's say I made $25,000 on it. It goes into a capital gains category. And then this year, I have to pay this $25,000 capital gain. But what I should be able to do is actually pull that $20,000 from 2019, drop it against, and now it's only $5,000 capital gain. It's those numbers. Okay. Because the categories sometimes are locked in, but sometimes they can pass over depending on, I guess, the situation.
Like when I moved over, I gave you guys my old tax forms, but it was like passing over analog files. Don't you really need all these back calculations or some digital thing ideally? The CPA doesn't want to give that to you, the old one.
Yeah, so basically it starts with the transition and just mention to your CPA, okay, I have this and this, and then your CPA will be the ones requesting per documentations needed. For as long as you mention it to them during the transition.
Okay.
I think if you kept your prior 1040s too, all that stuff is going to be in there. Like you can see what happens from year to year based off of 1040s and how that passes through.
Not all the time, because sometimes there's a year wherein the client did not have any, let's say, passive income or loss. Technically, the 1040 will only show active income.
Ray, I think when you brought this up earlier, maybe it might be good to start with the real estate professional status. Elaborate a little bit on that. Arvin, did you want to speak a little bit on the real estate professional status?
Generally speaking, you need to not have a full-time day job, either you or your spouse. So you single guys and gals, it's difficult to make this happen if you have a full-time job. But the harder thing is you need to do 750 hours of active participation in your portfolio. If you're in syndication deals as an LP, that doesn't count. If you've got less than a rental or two, it's going to be hard. Maybe if you can sharpen your pencil, RV. And what are some other ways you're seeing people like us get this real estate professional status?
First, you should eliminate your W-2 income, or one of you, if you're a couple, at least one of you should not have a W-2 income, because it's hard to prove right now audit that you're spending more than half of your time in the real estate related industry. We have an Excel file or a timesheet monitoring as to, you just need to log in, even if it's just an estimate of the hours that you spend in the real estate trade or business every day or at least every month, just to make sure if we get audited, we have something to show the auditor. One thing that I've noted is sometimes you're forcing the real estate professional, guys, even if you do not need it. So before you convert to a real estate professional, make sure to check if you really need to convert the passive losses into active losses to manage your income. Because some, let's say you're based on observation, like you have your early retirement and your active income is close to zero, then that's the time that we just keep the passive losses as passive losses. Another thing is if you cannot qualify as a real estate professional, but have a lot of rental properties, there's some strategy for this, which is establishing a management company. And the goal of that management company is to manage your rental properties or like your syndication investment, right? The good thing about this is some of your INDRA, you could put it under the management company and use the losses out of this management company as a deduction to your ordinary income. The reason why it's a mini strategy compared to real estate professional status is you cannot use the losses out of the depreciation stays with the property, which is why it does not give as much savings as a state professional.
What kind of deductions? What are some things that
If you have a management company that's managing your LLC, the real rental properties, now you could utilize, let's say, your meals and entertainment, you can claim it under the management company. But the most popular one is, let's say, paying the kids strategy, capitalizing your vehicle under that management company and depreciating it. Also, the Augusta rule, wherein you're technically renting your principal residence to your management company for 14 days or less for board meetings. So things like those, you could utilize it as a deduction, generating paper expenses that you can use as a deduction to your active income.
this is really old because we're talking about the Hui 3. So this is 4 years ago, but here were some ideas. Again, this is not tax advice. You got to work your own CPA. But when you add some of these things up, it's substantial expenses that you could be passing through
Correct.
there. Of course, it needs to be legitimate.
For every $1 of expense we identify, normally you save around 47 cents in taxes. So then it depends upon the state as well, but you can save as much as 47 cents for every $1 of expense you identify under the management company.
Yeah. Fun activity. I think the FOOM meeting before the end of the year, when it's like Christmas time, we have a fun thing where everybody says what they bought for themselves. That was a business expense, like our version of the Christmas office party. If you haven't caught on, guys, think of things that you can buy that is necessary for your business and get it in there before the end of the year so you can do it on 2024 instead of waiting an entire year. Time value money, folks.
Are all hours basically considered for the real estate count towards the REP status?
Technically, no. The hours you spend at an investor level, they don't count. Let's say you're just a passive investor for a syndication investment, and let's say you're checking in their accounting team, doing some research and all that will not count. However, for those that you are materially participating, let's say you have a property and then you're in charge with the improvements and all, those will count for as long as you are not technically on the investor passive level.
So a lot of our clients have multiple different properties. Are there any significance of grouping these rentals for the same purpose, for the REP purpose?
Yes. If we really need you to qualify under real estate professional, it might be best to group all those properties because the material participation test will now be evaluated on that group of properties. So you only need to prove that you spent 500 hours for managing those group of properties instead of like just proving, hey, for this one property, this is my proof I spent 500 hours. For this one property, this is my proof of investing 500 hours. So to like gate or at least reduce the administrative burden and give you a high chance of proving that you materially participated with that we need to accelerate the depreciation with, it's better to group them and then prove test the material participation based on that group of properties.
On this real estate professional status, we can hypothetically buy a property, rehab it, put it into service, and then by logging the hours, obtain real estate professional status, and then use the passive losses from syndication against active income.
Correct.
Can you also use passive losses that were carried forward that were suspended previously?
Depends on the property. Like if the source of that passive losses does not count on the material participation test, it will remain as passive. But if it does, yes, you can.
It's $300,000 of passive losses from other syndicated deals years prior.
Let's say qualified as a real estate professional, right? The next would be material participation. Now we need to evaluate on the syndication investment. Does he have any material participation? If not, it will remain a passive loss. If yes, then you could use the losses.
Grouping all of them together solves that problem.
Syndication investments are really different because it involves another entity and there's a K1 flowing that will show if whether you're a general or limited partner. It usually works for rental properties, like the rental properties that you 100% own. It usually works best on that.
That was my specific question. I wanted to use one property under renovation for 2025 to qualify for real estate professional status and use that to trigger the passive losses from syndications by grouping all of them together.
Yeah, unfortunately, it doesn't. It only works with like group of properties because there's K1 specific for syndication event.
So if it was 1099 on a different, that was not a K1, does that solve any of it?
No, actually, the 1099 does not show any losses. It just shows like an income. If you're planning that one, just make sure to do cost segregation on that property. So at least you can accelerate at least 25% of the cost and use that as a depreciation this year or an active loss this year.
Am I correct? In the year that you get real estate professional status, like if I got it in 2024, that only unlocks the passive losses that you accumulate in 2024.
So this is a way I've heard of. It might help explain what we're talking about here. My understanding is when you have a rep status for 2024, all the losses that you got that year is turned ordinary. Then and in the future, if you look at it from that point of view, the losses you got in 2023 when you're not a rep did not get transformed to ordinary. It was a passive loss.
Just the losses that's flowing to you during that time because there are. It depends again. It depends upon like the LLC or the fund where you've invested it when they will declare the losses. So the losses given to you during that time, that's the one that you can use as a deduction.
If I do the rehab on the one property and I qualify for real estate professional status, and then I have $400,000 worth of losses generated from syndications in the same calendar year, does it or does it not offset?
No, it won't. But again, you need to prove that you have materially participated and one of the evaluations on that group B if there are any K1s, right? So it works well if you combine it with other properties you own.
Also, a question on the depreciation recapture. If say you got in a deal and you got $80,000 of losses your first few years, but the deal goes south and the investment is gone, do you have to recapture that $80,000?
No, there's only recapture depreciation if you benefit on the depreciation. So let's say there's a depreciation right now and you were able to use it as a deduction to your ordinary income, then of course, when you sell the property, there will be recapture depreciation. However, if like you did not benefit, it was just suspended, then there will be no recapture depreciation.
Okay, so that depreciation capture is good as money then.
Correct. Now, let's say if you benefited on the depreciation recapture, and based on my experience with Pung clients, you're usually on the highest bracket, like 37%. So the depreciation recapture is capped at 25%. So whether your bracket is at 37%, the depreciation recapture will only be taxed at 25%. So you're saving around 12% in taxes, even if there's a depreciation recapture. My suggestion is if you have rental properties, accelerate as much depreciation as you can the first year you put them in service or you put them for rental.
That kind of goes to your earlier question. You're like, I'm getting these losses, but I can't use the damn thing. In a way, that's what's called like the efficiency portion of it. In a way, like you have to recapture, but you recaptured that 25% instead of like those higher tax brackets. So there is some benefit to it, even if you don't use it.
It doesn't sound like rep status is really going to help me because it's syndication. Even if I bought a couple of rental properties, I can't really use it against that. How do you use the hundreds of thousands of dollars of suspended passive losses from syndication?
Actually, you just need to generate passive income moving forward. Mostly accelerating your passive income would be the best route.
This is where you get into some ideas like, I'm going to talk to a franchise guy, but you buy a crappy franchise and you pretty much make some money, but then now you change it to passive income.
There's always a different way to look at it. So much of it's strategy, right? I thought I was going to be able to eventually hit this rep status thing and then dump all this against my ordinary income.
It doesn't work retroactively. If he has rep status, all your new, if you go into 5 deals this year or next year, all that will be for like being able to do it. But retroactively, it doesn't
but
go
you
back.
still need, again, we go back to the next step, would be the material participation test. Also, let's say we cannot defer capital gains. Another thing, zeroing out your other income, right? As mentioned a while ago, capital gains is taxed based on like your other levels of income. Let's say you're generating an active income of 100,000 and you have rental properties. We can classify you as a real estate professional or Airbnb property to simplify it. Accelerate the depreciation of the property so that we have a high chance of reducing that 100,000 income to below 44,000. You will be taxed at 0% on the remaining capital gains for selling, but need constant coordination with your.
I heard you say that strategy, put it in an irrevocable trust.
Huh.
You have a gain on something, or can you put your crypto in an irrevocable trust? And
Yeah, but the problem is your money stuck there. So when you take out the proceeds or the money, then it will be taxable on your end. Let's say you have $500,000 in trust, then there's 250,000 capital gain in that one. If you withdrew 100,000, then 50,000 out of the 100,000 will be classified as capital gains and it will be taxed at.
but what if I took $100,000 in crypto, put it in my irrevocable trust, but then I sold that and in the trust, and I just take a loan from that trust and I pay myself 10%.
Yeah, it won't generate capital gain. However, it should be an irrevocable trust and make sure it's controlled by another person so that it will not generate taxable income on your end. When you move the asset into a trust, the financial advisor handling the trust also gives you a promissory note with interest. So you're earning interest out of the money that they borrowed you.
How much are you guys setting up these irrevocable trusts? It's 20 grand to do one of these
Yeah,
things.
it's a case by case basis. So
Yeah.
depending on how big the amount is, plus of course we need to coordinate with the financial advisor because technically they are also charging percentage as to the asset they're managing inside the trust. So it's a case by case.
Because it's basically like that DST thing, but essentially you're doing the same thing without the cool name behind it.
Just based on experience, normally if the capital gains is $1 million or less, I do not advise high level strategies. But if it's more than $1 million, then I look into it again.
If somebody has an elderly parent that's in their 90s or even in their hundreds, they got $1 million house. You put the house in that irrevocable trust, and then that trust can sell the asset and make loans out to the offspring and get that money moving, as opposed to waiting till that person dies.
Correct. Yeah, there are those strategies. You can dictate the trust if there's an irrevocable trust and you control it. You can dictate, hey, use it for investing in syndications, right? And then any income it generates, it will not be well. Okay. Next, for Evan here, if you sold a rental house and made 200,000 in gains from the sale, would this be able to offset and use up those files that suspended? First, 200,000 gains, and then see if there are any suspended losses coming out of the same rental property. If yes, then you can use it. But if it's suspended losses out of a different rental property, then you cannot use it.
Obviously, we know now who's going to be president. So
Mhm.
Trump's coming in. We had some tax cuts that he put forth last time, and they're 2017, but they're going to expire. But I assume he's going to pass it all. What are some things that we might think about planning with our next year with our
Yeah.
tax because of the new president?
Based on my experience, the main thing that would generally benefit you would be his planning to eliminate the cap with the state and local. So with the state and local taxes, it will not be limited to $10,000. And usually you pay a lot of property taxes, or if you're in California, you pay a lot of taxes in that state, right? So whatever taxes you paid in the specific year, you can now use it as a deduction. Also, there's portion in there that we're waiting details with, wherein there will be benefits for investment in real estate. That one, there's no detail yet. If there is, I cannot disclose it yet because it might change. But there might be some exceptions if it's income from real estate or accelerated depreciation. But I cannot promise yet. However, I'm coordinating closely with Lane around February. I'm expecting that by that time we have a clear picture. So we'll do another training with you guys and like how the new Trump tax law will benefit you. It might be worth it to extend your filing because they're planning to replenish the depreciation to 100%. So I'm not sure if you heard that you can only accelerate up to 60% right now, but both of them, they're planning to replenish it back to 100%. It might be best to wait. And then that's the time that you file your taxes because knowing you guys have a lot of depreciation.
It's sad because things are going away, like conservation easements, oil and gas isn't as strong. And it's like when adding something like, some new category it's long overdue, right?
Correct. Also, I just remember it might now be worth it to invest in a C corporation because C corporation tax on 15%. We have one client who moved to a higher level of group in. We move all his property into a C corporation so that it will be taxed at zero because it's generating a lot of rental income out of his properties right now. And for the conservation easement, we remove the easement as part of our strategies because since June, I've received a lot of notices from auditors. We have a lot of clients being audited because of easement, but hopefully with this new presidency, it will not be.
If I have multiple businesses at my home, I know that we break down each based on the square footage of that room that they use. But if I was just having the house repainted, I'm curious if I'd be smarter to just pay it personally and let the businesses take a deduction or use one business, or does it not really matter in the end? It all works out the same.
So the rule per IRS is for as long as you spend something that will not increase the value of the property or the life, it can be exempted under the capitalization requirement. So if it's repainting, it's best if you pay it in the year that you need it. Let's say you have a lot of active income and you have a rental property, say this is an Airbnb property or you have a management company. It's best if you pay it under the management company the year that you need it. Painting is one of those that you can classify as direct repairs. So it's better if you classify it as a repairs instead of a capital improvement. Because if you classify as a capital improvement, then we go back to the depreciation requirement. It's best if you utilize the deduction as soon as you can rather than capitalizing it and depreciating it. Plus, that one will not be subjected to recapture, depreciation. It just does not increase the basis of your property when you sell it.
That makes sense.
I have one. I shifted some of my earned income from W-2 to 1099 to get some other business type write-offs, as well as use a self-directed 401k to be able to hide more. What's the best way for me to estimate how much I could put into that? I know it's based off of how much of that 1099 income I would have. There's like maximums dependent on that, like the business contribution versus the personal contribution. I had a little struggle trying to decide ahead of time this year, not knowing my final.
And then just a few questions. The first one is a little silly. How long have you been working?
The 1099 income,
No, how long have you been receiving?
W-2 income,
More than 10 years?
not with my current employer.
But
yes.
overall, more than 10 years, right? Because I just want to make sure, because sometimes moving to 1099 is beneficial. However, our client forgets they need to complete 10 years of working as a W-2 individual or self-employed to contribute to pension so that when you retire, you will receive pension, right? So if you are more than 10 years, that's fine. And then 1099, did you just ship it as 1099 and under your name, or did you establish an LLC or S corporation for it? It's best is if you establish an LLC, right? Because without the next advice, the moment you run out of expenses plus the strategies and you're still generating a net income, if you're not under an LLC, on top of your current bracket, let's say you're paying 24% in taxes, you'll pay additional 15.3% in self-employment taxes, right? The moment you foresee that the net income will be more than the expenses and the strategies, inform your CPA about this, convert the LLC into an S corporation to eliminate that 15.3% additional taxes, right? You need to coordinate with your CPA about this per tax plan. Estimate as much as you can how much recurring expenses you have that you can classify for business purposes, like paying the kids, home office expenses and all. You could find the ratio as to how much of your W-2 income needs can be converted into a 1099. Do not convert all of it because, as mentioned, it will be subject to ordinary income tax, right? So just estimate as much as you can how much expenses you produce on a recurring basis, and that would be your guide as to how much of your W-2 income should you convert as 1099 income, but 1099 income should be going to your LLC or S corporation, not to your name, just to prevent self-employment. And also part of the consideration would be the solo 401k, the 66,000 limit. So add that in immediately. But again, there are some income requirements that you need to adhere to on that one. So it's a discussion with your CPA.
I had the discussion last year and thought about doing the S corp to give myself a salary to avert some of the self-employment tax. But because my W-2 income is so high, I wouldn't owe a ton of self-employment tax because I would have capped out most of it already. And then having to do payroll and pay for all those services ended up being almost more of an expense versus the loss based off of how much 1099 income I had. So I ended up not doing that last year. The only thing I had around that was contributing to the self-directed solo 401k because I didn't need to have all of that. It sheltered a good bit of the money, but I was left to dry almost.
I'm not sure what bracket you are right now, but if you're on the highest bracket, might as well consider opening up a C corporation. Whatever income you rerouted to another type, it will be taxed at a 15%, 21% rate. But I cannot give further details until I see it.
Even the solo 401k stuff, the way I look at it, it's like punting to the future. It's really deferring it. You're just,
I'd be losing almost 40% on all of that money. So it was better to have it something that was going to grow a lot and then I could take it when I could control my income or have more passive income. Everything's passive and not active that I could then draw it.
One question, Lee had, if a limited partnership sells at a gain, can passive losses be used to cover the gain since the property is sold?
Got it. Yeah, I'm assuming this is sale, like a total exit, right? So they sold the property and they gave you back the investment that you have, right? So if it's a sell, then that's the time that it will be classified as capital gains. And from that capital gains, you can deduct the suspended losses that you have out of that property, right? And then the remaining ones would be subjected to capital gains tax, which is either 0, 15, or 20%.
I got last couple questions here. So it has to do with health insurance. If you're able to drive your marginal adjusted gross income down to a certain level, you get free healthcare. Maybe you can talk a little bit about that.
Actually, this one, I cannot like details. Yeah, if you need it, coordinate with your CPA as soon. How we can reduce your modified adjusted gross income. I have clients where I converted in the C corporation just to make sure that the only income flowing to their 1040 is like their pension income. So in that way, at least they qualify on the modified gross income, which is 400% of normally the federal poverty level.
Yeah. Which is like 60 grand is what you got to get under. But what's the difference between AGI and MAGI? Like,
Modified adjusted gross income is your income without social security income, without your losses or gain out of passive income, such as rental losses, rental income. So if you remove all of those, that would be your modified adjusted gross income. Remove the passive income coming from rental and capital gains or capital loss, that would be your modified adjusted gross.
and we'll end on a light one. Credit card points and cash back on my credit cards. My understanding, the reason why you guys are making me expense that as income or take that on as income is because we're just using my entire bank statements and just running it through the P&L, right? Some people found a news article that says credit card rewards are not taxable, but
Technically, they are. But again, it's better if you take on like the benefits so that you classify it as an expense. This is more on the audit side. If like you encash it and there's like cash that flows into your bank account, then if you get audited, of course, those will be asked and what they will ask, why did you not classify this as income? So it's more on the audit side. So it's better if you have a lot of points, just use the benefits instead of encashing it.
cash. If you really get down to it, you're okay to take it as cash and not pay tax on. But is it even worth it? Because it's going to
No, not
figure
really.
If you had it go back on your statement versus into your checking account. So if you owe $2,000 on a credit card and you get $50 back toward it, just put it against your statement. It never really goes into your bank account. So that might be, I don't know.
But,
I mean,
but they track, I have them track all my credit cards.
Problem is you will have reduced expenses. Let's say the amount that you spent for travels minus the credit. So technically the expenses that you will report under the books will be net off.
Common question that comes up a lot of times. I have passive income from my rental properties or my syndications, and I see I get a lot of these losses from depreciation coming from my rentals or on a K1 from a syndication deal. Can I use that to offset passive income from that deal or other deals?
Yeah. So technically if the other deals are also on a passive level, then definitely you could offset the passive income from those other deals to the passive losses that you have currently. However, the income is ordinary income, then it will be subjected to the passive activity limitation, which will prevent you from deducting your passive losses to your ordinary income, which is why you need to find loopholes, just real estate professionals, to convert those passive losses into active losses.
A common thing I see from a lot of people who have archaic CPAs is they say, no, you can't take the passive losses from one deal and apply it to other passive income from another project. They're trying to use those losses that are starting to pool up on other projects, but their CPA is blocking them. Why might they be seeing that or hearing that, and what can somebody do other than just changing a CPA?
So that you could offset the passive income from those other deals, especially if those other projects are on a passive level as well, then you could use those losses as a deduction to your
Passive income comes up probably way too often. I would say 80% of people typically change their CPAs in the first year or two, other than simply getting a new CPA. Is there some kind of tax code that they can look up, or what would you suggest for somebody in that situation?
Just be aware about the passive activity limitation for IRS. And then my suggestion is do tax planning with your CPA, especially now. I think this is the best time to do tax planning, because without proper tax planning, you'll be surprised that losses that you cannot use as a deduction to your other types of income. Maybe you've misinterpreted some of your passive income. Like you initially thought it's a passive income, but in reality, let's say you're materially participating, which converts it into active income. So to prevent those surprises, I suggest to do tax planning. with your CPA. If you cannot do it like 4 times a year, do at least once or the last quarter or at least near the end of the year.
First question is, what is the best way to do a Roth conversion? Someone just rolled over their 457 to a solo 401k or self-directed IRA.
Way to do a Roth conversion would be the year you have a very low income or the year you're receiving a refund. Because when you do a Roth conversion, especially if it came from a traditional 401k, traditional IRA, any conversion you do to Roth will automatically be classified as taxable income during that year. So to prevent unexpected taxable income during your tax planning with your CPA, once you already know how much tax you are going to receive refund for or like tax you're going to pay, coordinate with them. Like, let's say, hey, I'm planning to convert some of my traditional to Roth so that they could factor in. Normally, the way I do it is if my client is on a refund position, I work back to a certain level of income to enable my clients to convert to Roth without paying additional taxes on their end.
The CPA doesn't know what kind of deals you're going into. They don't know how much passive losses you're going to be expecting to get. They don't know when your deals are cashing out. So really, you have the best point of view. Like investing, you never know what's going to happen. And even from a tax perspective, you never know what deals are going to go well and you're going to have those capital gains to pay and the depreciation recapture. One year I had a situation where I had a whole bunch of passive losses, at least a few $100,000 worth that I didn't use. Our strategy that year was to drop our AGI way down to pretty much zero. Familiar with the AGI charts, you don't really get much of a cost savings when you burn up your suspended passive losses in those lower tax brackets. But in terms of time value of money and getting money in my pocket that year, and invest it, it made sense. I guess the point I'm trying to make is like, there's no one way of doing it. And there's always, you got to play both sides. It's like playing cards. There's no one way of playing it. Things could happen. For all we know, the next year, you could have had a lower income year, for example.
Correct. There's one question here. From my personal funds, I transferred 80,000 to my business account to purchase a 401 SR in Memphis with cash. How do you treat this transaction for tax purposes? Under your business book, you report it as the 80,000 transfer from personal funds to the business. That should be reported as an investment to the business. Once the business purchased the 4 SFR in Memphis, that will be treated as an investment under the books of the business. If you receive the reimbursement, it's not taxable. However, if you receive shares from the income of your investment, and that's the time that it's converted into a passive income. So determine what type of reimbursement you receive. If it's mostly return of capital, it will not be.
Yeah, there's always this like conversation between, is it return on capital, which would be most times a capital gain that you obviously have to pay tax on, or return of capital. Like if you do a refinance, you're just taking money out through a loan and that's not taxable. In some deals, you work with your CPA to categorize it accordingly. If you can push it to return of capital, you can delay paying capital gains on money pulled out of the deal, assuming it was not like a capital gain that came from it. The conversation about passive income versus ordinary income, these types of things we're talking about here, it really took me about a few years to keep hearing this stuff again and again before you get somewhat aware of this stuff. And as I always say, you really have to educate yourself. You can't just blindly trust your CPA team. Pick a good one. But moving on to the next question, in a solo 401k, is there no UDFI tax and is a Form 990T filled? Maybe start off with what the heck is UDFI for most people don't know.
Yes. So this one, it's the unrelated income. So normally if you have income where it violates the requirements of a solo 401k, like let's say you've invested it to something that you're currently managing, then technically the government will tax you on that. I think you're asking if the Form 5500 needs to be filed. So my answer is it depends on the total value of your net assets. If your net assets are valued at 250,000, so meaning that if the asset is still valued or the group of asset is still valued at more than 250,000, then you need to file your Form 55.
People typically start using retirement funds for these types of investments because they've got their money in their 401k, or they might have other money as cash tied up in investments already. But in reality, I don't know if retirement funds, qualified retirement funds, QRPs for short, which are solo 401k, self-directed IRAs, are really the tool for the job. The reason is with real estate, you get nice tax benefits like depreciation from the investment. And when you invest through one of these qualified retirement plans, solo 401ks, IRAs, those tax benefits are insulated from helping you out personally.
Correct.
But if that's all the money you got, that's all the money you got. Next question coming in here, a specific question for an expat here, foreign income under FEIE limit. However, in 2024, began receiving distributions from real estate syndications within the US. What is the best tax strategy for a guy overseas?
In your case, I'm assuming that you did not give up your US citizenship or green card rights. If that's the case, the best strategy is first identify what type of distribution you're receiving. If it's a capital gains distribution, zero out your other income. Because remember, capital gains are taxed based on your other income. So if you're like, let's say your income is lower than 44,000 a single, your capital gains will be taxed at 0%. Utilize the FEIE or foreign earned income exclusion limit. As long as you're below that, the capital gains will not be taxable. But in the year wherein you have foreign income more than the foreign earned income exclusion, then coordinate with your CPA to further reduce your ordinary income to ensure that the capital gains will not be taxed at a higher bracket.
So what is that, RV? The guys living overseas, there's a certain threshold.
100,000.
So likely they're getting paid in their home country, several 100,000. But if they have syndication deals where they're getting paid 50, it flies under the radar, or they don't have to pay taxes.
For the foreign earned income exclusion, so these are like the incomes, the expats or US citizen or resident income from other countries, right? And then the IRS will give limitations. Either they claim this foreign earned income exclusion or a foreign tax credit. So technically, they're claiming up to 100,000 of non-taxable foreign income to reduce the taxable income here in the US. So if you have US source and based on message is mostly capital gains, it's best if you zero out the ordinary income to take advantage of the lower bracket for capital gains purposes.
The foreign income tax exclusion limit now in 2023 went up to 124,000. So seeing that I'm below that threshold, once some of my syndication deals do start to wrap up, with the help of a CPA, are you saying that I could potentially pay 0% on those capital gains?
Correct. Provided it's capital gains, not passive income. So let's say they're ramping up and then they're giving you like share of the ordinary income. So that's a passive income, which is subjected to ordinary tax bracket. But if it's an exit and then they're closing the funds and giving back what you've invested plus your share in the capital gains, then you follow the capital gains rules.
So like I got a guy that he's a resident of Canada or resident of Japan. How does that work? RV?
Depends if they of their US citizenship or green card, then technically in the US, because the rule is if you are US citizen or green card holder, you are taxed on your worldwide income, whether you earned it in Japan or you still need to report it as an income in the US because you're a citizen of the United States. However, they gave some leeway, as mentioned, the foreign earned income exclusion or the foreign tax credit, whichever is more beneficial to the taxpayer.
Okay, so what if you're not a green card holder?
If you're not a green card holder, then you are only taxed on your income that is sourced in the US. But let's say you have interest income in the US, right? Or let's say you earn salary in the US while you're a resident of Japan. You now need to report that portion the salary that you earn in the US, and it will be taxed.
Okay. So you got to pay like a whether it's salary or a investment property or syndication, you pay your tax here, then you got to re-domicile it, and then likely you pay taxes back in Canada or wherever. Question that comes up, people, they have LLCs, you have a professional job or you run a business. This real estate investing thing is a side gig, but you create an LLC to document different expenses. Maybe go through some of the common ones that you see, because at least when I first started to hear this, I was like, I didn't know I could deduct my cell phone, some vehicle, office, but maybe go through some of the low-hanging fruit that you work with a lot of your folks with.
All right. So let's say you have multiple rental properties, the syndication investment, and then you cannot qualify as real estate professional. However, you're directly managing, let's say, the rental properties. If you've established a management LLC, you have an active business to manage those rental properties. The good thing about this LLC is that it's an active business, meaning any losses it generates can help you reduce your other active income. So if you have a management LLC, then you could do the strategies such as home office expense strategies, capitalizing your vehicle and depreciating it in the LLC. If you have kids, paying the kids strategy, so that's currently 13,000 per kid, that would generate your paper losses, plus all indirect expenses for managing the property that you cannot claim directly under the rental properties.
What if you get your passive investor and you get your investment friends together, or have a dinner, have a meeting? At one time, they said you weren't able to write off meals and things like that. But where are we at? Last year, they wanted to incentivize people to go out, but that kind of went away. But where are we at today?
Those things, if the dinner is like with your passive investors, friends, then you can claim it as meals or entertainment expense under the business. Just take note, only half of it is deductible for IRS, but still claim it under the business. And my suggestion is, if you have those types of events, use the company's credit card for payment, or use the management LLC's credit card.
Yeah, and that was something that I picked up the last couple of years. Instead of paying cash is always scrutinized, whereas credit cards, I mean, for some reason, they just fly under the radar.
Probably too much. You claim a lot of the entertainment, and definitely if like you don't have your own company's credit card and you're just using your personal credit card or debit card, then that's the time that you increase audit risk.
We started to use QuickBooks a couple years ago, and that's been a total game changer. I don't know how much that thing costs, maybe several $100s a year, but people have used mint.com. You just connect your credit cards and your bank account. I use a certain credit card for meals, another 2% credit card for miscellaneous. Every credit card is already connected with a certain account. So there's really no bookkeeping that needs to be done. It's automation that if it comes in through a certain channel, we know what it's for.
What is FinCEN? Why and when do you have to register? FinCEN, it's Financial Crimes Enforcement Network. However, William, are you referring to the FinCEN 114, which is technically the FBAR, or FinCEN Beneficial Ownership Information? If you're referring to the beneficial ownership information, this is a new disclosure required for LLs, for companies who register. It's a new requirement for all business owners to declare who are the owners of the business. Normally, if you open up a business before this year, you have 6 months to comply to that requirement. But if you open up the business 2024, then to comply with the requirements. But if you're referring about the FinCEN 114, so this one is if you have foreign bank accounts, at least $10,000 during the year, then you have to file this form together with your tax return. So it's more of disclosing your foreign bank accounts in the US.
I get a lot of emails from CPA lists, but they all like to scare you. If you don't get this done, you're going to go to jail. The government wants insight into who owns LLCs for good reasons. They don't want people to hide behind entities, and they want to catch the bad guys. So some people get really upset by privacy and everything, but it's a pretty simple process to do. I think I pay like $100 something to have the CPA legal team do. That way I can blame them when they don't do it.
Just a heads up though, let's say you have foreign bank accounts and you forgot to file or you disclose this bank account. Consult your CPA because let's say suddenly you're saying to the IRS that, hey, I have a $1 million worth of foreign bank account. So that's the time that you receive notices because they'll wonder how it reached that amount right away, right? And there are heavy penalties for forgetting to disclose this bank account. So before you file your misfilings for foreign bank accounts, consult your CA to ensure that you'll cover any notices or penalties coming your way once you file it.
Let's go into the real estate professional status section here. You got ordinary income and you have passive income where you can use passive losses to offset the passive income. You can't use the passive losses, the depreciation from deals to offset your ordinary income. There's a wall there unless you have real estate professional status, which essentially removes that wall and allows you to use your passive losses to drive both incomes down and pretty much gives you free reign to drop your adjusted gross income to zero, assuming you have enough passive losses at that point. There's a lot of ways of explaining it. That's why I got RV here today. But essentially, you or your spouse can't have a full-time day job. Maybe your spouse is stay at home or part-time. That person can qualify on behalf of your couple. The second one is going to be the harder one. You need about 750 hours of active participation per year in your portfolio. And that doesn't really count being a passive LP in syndications. But Arvi, why don't you expand on that? I know there's a whole bunch of being it complicated in the weeds. If anybody has specific situations they want to go through, Arvi, anything you want to build on to that?
Yeah. So just make sure, let's say, okay, I already qualified as real estate professional. That's 750 hours. I can prove that I have 750 hours worth of real estate related trade or business. Take note of the second requirement, which is the material participation. So those losses wherein you're planning to convert it into an active losses, make sure that you qualify as materially participate to this investments, right? If like it's a syndication investment, then make sure that you're a general partner. If it's a rental investment, then that's the time that you'll undergo the 7-part material participation test. Make sure that you at least qualify to one of those 7 requirements. And that's the time that you will be able to convert the passive losses into active losses. Now, let's say you have multiple properties that you want the passive losses to be converted into active losses. My suggestion is group those rental properties because the moment you group them, you only need to prove that you are materially participating into the group instead of your materially participating to this one property, to the other property and other property. So instead of proving individually your material participation per real estate, group them and prove that you're materially participating in that group. So in that way, it gives you less administrative burden when it comes to proving that you are actively or materially participating with those rental investments.
Yeah, another thing that comes up a lot is like the short-term rental loophole. We're not going to go too much into it, but the general idea is get a short-term rental property, work with your CPA and have it qualify now. But to me, I don't know, I'm not a huge fan of that strategy because essentially it turns into this non-passive, it's a real annoying procedure where you have to buy a rental property every single year. So it's not really sustainable long term. I think most people here are trying to get away from active involvement. A lot of people hear about real estate professional status and yeah, you can use passive losses to lower your ordinary income. But unless you're in the higher tax bracket, I don't know, RV, what's your general rule when you take a look at people's profile for that? When does it make sense? What income level as a couple?
If you have a high active income or ordinary income and your bracket is already at the 35 or 30%, plus you're okay with investing in short-term rental properties, then that's the time I would suggest for you to utilize this strategy. Also, once you've utilized this strategy, don't forget to do cost segregation study so that you'll be able to accelerate majority of the depreciation of the short-term rental property day. And then let's say next year, you don't want to do it anymore. You could convert it into a long-term rental property. However, you won't be able to utilize the losses it generates to reduce your ordinary income.
If you're making over $300,000 to $400,000, this makes sense. Every situation is different. We're obviously not giving any tax legal advice. Everything here is just generalities.
Right.
But
Let's say you have a big capital gains and you need to reduce your ordinary income to qualify either at 0% or 15% capital gain. That's the year to utilize it. If you have a big capital gain and there's a way to reduce your ordinary income, utilize the short-term rental.
we've got the 8 ways to mitigate taxes masterclass in the members portal for people to at least educate themselves before they talk to the CPA. Ideally, you watch those videos before you start to work with a financial promoter who's going to sell you some kind of tax mitigation tool. But you want to know the options out there and then talk to more of a neutral party like a CPA who's going to work with you or open to working with you with this type of stuff. But I guess, RV, what about the single guys? We got a lot of those single bachelors, ages 45 that make $250,000 a year. They're put in the highest tax bracket. They may not be looking for love out there, but what do they do with taxes?
Find ways to reduce the ordinary income. That's the time you go with the management LLC strategy or like fully maximizing your 401k contribution, the $23,000 threshold. Or if you're frequently donating, consider the donor advice fund strategy, meaning you transfer like stocks or cash to a donor advice fund. What that will do is it will accelerate the recognition of your charitable contribution, which would help you in reducing that 250,000 income. The good thing is you do not need to distribute the amount you transfer to a donor advice. You could instruct the fund when to donate it to the charity. And even if you've donated it to a nonprofit that's not qualified per the IRS, you could still utilize for contribution deduction. Another thing would be syndication investments and things like those, but just make sure that it's not classified as passive income. So find ways to reclassify it into an active losses.
What about some of the more exotic, more risky options like oil and gas and land conservation events in 2025? What are you seeing out there?
Oil and gas investment is still one of the strategies that we advise our clients. For the East, it's a good strategy because like for every investment, normally they give you, based on experience, like times 4 as times what you've invested as charitable deductions, right? So those are good types of investment to reduce your taxes. However, for easements, just take note the risk not only of losing your investment, but also of being audited by the IRS. Because right now, there are a lot of notices from auditor asking like, how did you arrive at the valuation of the charitable contribution, right? Just take note of that risk and make sure when you're investing to the easements, you're also in line with the CPA of those funds because they will also be audited, a game plan before the audit arises. On the oil and gas investment, that one, it's less audit risk. It's a good tax deduction. However, financial wise, just take note of the risk because if they dig and there's no oil, you might lose all your investment.
From the operator standpoint, I haven't really found a good operator in that sector. Of course, if anybody out there is working with somebody and they've done more than a handful of deals with somebody successfully, please let me know on behalf of our group. Oil and gas, it's a bit of a cowboy world in terms of operators. And to echo what RV saying about the land conservation easement, for those who aren't familiar, like Donald Trump does this with Mar-a-Lago. He's got that nice estate out there, but some of the land was donated, put into a land conservation easement. And the idea is before you give it away, you bump up the evaluation 4 times, 5 times. Some people do it 10, 20 times, which is obviously very egregious. The idea is if you go into one of these deals with $100,000 and you get $400,000 of deductions, at the highest tax bracket, that might be worth 200 grand and you only paid 100 for it. But after the omnibus bill, a lot of these are being fought. We've talked in great length in the past about it. I personally never done one of these things because I just use real estate to lower my income that way. I see a lot of those audits coming through, and sometimes the operators are just taking the buyout and sometimes they're fighting it. But RV, most times it's the syndicator, the operator who's getting audited on the deal level. You're seeing it come back on the actual individual taxpayer, or how does that
Correct.
all work?
Because if they lose or like they got an unfavorable audit conclusion from the IRS, so basically all those who took the deduction would now be disallowed. Like the deduction that you took, if the LLC lost, the IRS will disallow what you're claiming or they will reduce it. All the partners or investors of that LLC will now be asked if they want to push further for litigation or they just want to take on what the IRS said that they could deduct and then pay the corresponding taxes plus penalties and interest relating to the tax due. And then maybe just an advice if you're using easements for tax deduction purposes, just make sure that you really need it. There are limitations, the 30% limitations as to because whatever you've invested multiplied by the fair market value, they will be treated as charitable contributions. Charitable contributions has 30% limit on the AGI, 50% if it's cash. Take note of those limits because some of our clients, even if they've invested to this, if the total amount or the total fair market value is more than the 30% their income, what happens is you'll just carry over that charitable contribution until you fully exhaust it.
Yeah, so what RB's saying is, say your AGI was 400 grand and you did $100,000 of conservation easements, which got you 400 grand of at a 4x multiplier for that one deal. You got $400,000 of deductions. You can only use 30% on those and 50% on cash. So you could have dropped your income from 400 down to 200, I guess is what I'm saying. But yeah, as far as due diligence, when you look at these sources and uses, I don't have experience doing it. I'll call myself out, but it's nice to see a big line item for reserves for litigation. If you do one of these things, you're going to have to go to bat for it. So you're going to need those reserves for it. If you're in one of those deals with less legal reserves, those are probably the funds that as a group, they're saying, we're just going to take a loss or settle. You're seeing some of these groups fail, give up, and have to give back the deductions. But are you saying the syndicator operators telling all their investors, you have to give up these deductions, but the individuals aren't reporting that on their taxes?
Most of the funds would go to a hearing or they would like to elevate it to litigation. And most of the time, they already have budgets on that one. If you do not want to push through with the litigation, normally what will happen is for all the partners who doesn't want to push through with the litigations, right? What will happen is they will also ask you to shoulder the penalties and interest of those partners who agreed to go to litigation. So there are things like those, but it really depends, right?
That's good to know because I was kind of under the impression that passive investors just go with what's happening with the operator, the syndicator, and the parent company, and it's not really on them.
For those things, like if it will materially affect the business or the assets of the business, normally it's rotation between partners, even if you're just a limited partner.
Just wrapping up here, you guys see a lot of investors. What is the most common question you guys get that we didn't really talk about here?
The common thing that you forget, let's say you're a real estate professional or you've invested in a rental property and want to utilize as much depreciation as you can to reduce your ordinary income. Most of the time, my clients tend to forget doing a cost segregation study. So if you purchase a property and it's an active property, meaning it's for short-term rental, or you're a real estate professional and you're materially participating into that property, then do cost segregation study. In that way, cost segregation study, what that does is, let's say you purchase a property worth 200,000, right? The building is cost 100,000, right? So what the cost segregation study will do is that 100,000 will be further divided into let's say out of the 100,000, 50,000 is for improvements, 30,000 is for fixtures, and the remaining 20,000 is the building cost, right? So if you do a cost segregation study, that $80,000, you could now accelerate the depreciation of it. So meaning you could expense that $80,000 a year. If you do not do a cost segregation study, that full 100,000 will be divided equally for the next 27.5 years. So it limits the depreciation that you can utilize every year, especially in the first year you put the property in service. So yeah, just a reminder, if you purchase a rental property, that you can use as a deduction to your active income. And also a reminder, so we're close to the end of the year. So this is the best time to pay your kid, contribute to your solo 401k, maximize it, pay yourself, capitalize the vehicle, and also this is the best time to do it because some of those strategies are time sensitive. Once you pass on the 12/31 deadline, then you won't be able to do some of those strategies.
It is a boring time in terms of taxes because what were some of the big things that people would use over the last several years? Conservation easements, oil and gas. We talked about how that has cooled off. And then the bonus depreciation thing that was around 3-4 years at 100% that has come down and starting to sunset. The government branches changing. It is opening up new possibilities that are maybe total out of left field, like opportunity zone, how that kind of was out of left field, or maybe the return of R&D credits, or some other just deductions just for real estate things, for all we know, right? It's about time that something new is thrown in the hat, and we'll do a webinar just like this in about a month or two to recap once the presidency has been decided. So now they're actually going to come up with real policies that are going to come through. But I've got a last couple of questions here. Maybe RV, you can explain. I had an investor, they started investing in deals. They understand that they can get the depreciation and the cost segregation that you're mentioning. Oftentimes the general rule is 1/3 of the losses. In that past example, $100,000, 1/3 of that all in the first year.
Correct.
And this is where it's way more than just a single family home. It's 27-year straight line depreciation. And that's where it opens up to get all these passive losses. But his argument was he doesn't have a very good CPA to use those losses and he's not doing rep status, but he didn't quite understand the advantages of it. If you can explain, like, you get the depreciation, but when the deal exits, you got to recapture that.
If you're concerned about the recapture depreciation, so actually don't worry about it because recapture depreciation are taxed at the 25% bracket. So if your bracket is already at the 35%, 37%, right? It's still best if you utilize the accelerated depreciation the first year, you put it in service. And then when you sell the property, any depreciation you claim prior to selling the property, that would be classified as recapture depreciation, which is taxable at your ordinary rate. However, your ordinary rate would be fixed at the 25% rate only. There's still technically a savings of around 12% if you utilize the accelerated depreciation rather than just letting the full 27 years per year.
So that it's a little bit concept of tax efficiency. So if you're in the 37, 39% tax bracket, you're saving that and then you're paying it out on the 20 something, 25%, like RV says. That's where you have to get with the program, to say the least, unless you get around other investors that are using these types of strategies, paying their own kids, doing real estate professional status. You don't really tap into more needle moving strategies. That's why we tell people we'll come to Hawaii in January, meet other people doing this type of stuff, and you'll get with the program. Because if you're just listening to a podcast all day long, you're not going to really get this stuff unless you get around other accredited investors doing this stuff. What are some of the common gotchas that potentially trigger audits for real estate investors?
I will not answer it directly, but maybe an advice. Monitor your effective tax rate. So the effective tax rate is your total tax divided by your actual income. Monitor that one. Coordinate with your CPA as to how much lower can I reduce my effective tax rate without my audit risk increasing. In my case, if the effective tax rate of my client is below 20% because of the tax strategies, then that's the time I hold off or remove some of the strategies I advise my client. But it's a case by case basis. If it's a real deductible expenses and and have no choice and it's reducing your effective tax rate to a reasonable level, then just prepare the documentation related to that strategy. But if an optional strategy and you're already at a non-reasonable effective tax rate, then consult your CPA. That may be the time to increase your effective tax rate to the reasonable bracket.
Try and be around where everybody else is. But in reality, for everybody that's listening to this call, most people here are pretty far off of that for their class of workers for the most part. And I think that's where there is a lot of articles put out there that kind of scare people into taking the home office deduction and get audited. Is pretty much clear, black and white. The IRS wants to incentivize people to invest a certain way, and it's legal, right? We're not saying anybody to do anything illegal here, but I think that messaging kind of scares people away. Then it shouldn't scare the masses is what I'm saying. And that's where working with a little bit more aggressive CPA might be the path forward. But again, that comes back to you are the 5 people you hang out with most, and people don't know the difference between ordinary income, passive income, and how passive losses offset passive income. And then you got to get with the program. RV, let's take out all the egregious fraud tax people, right? I don't think you guys are working with any of those types of people, but the audits that come up for somebody to defend something, what does it normally cost? $5,000 and just some billable hours. It's not that bad. Part of the cost of doing business, the way I look at these things. Don't do anything illegal. Don't do fraud. Do things smartly. But at the end of the day, that's why you need to have a CPA that's confident is going to stand behind you if these things are called into question. But if it were to call it in question, you shouldn't be losing sleep.
Personally, I was trying to see how much more I can push on things. That was the reason for asking. I think the effective tax rate, that's a good way to look at it.
I think most of the folks that we work with, they normally start in like that 35, 40% tax bracket or zone.
Yeah.
Getting people down to 20% is not out of the ordinary. Somebody's out there's probably thinking, what's wrong with me? I'm paying almost double that. And that's what we're talking about.
Just as an example, my effective tax rate for the past couple of years have been in the 20 range. And that's why I think this is helpful.
If you think like a business person here and not like a cheapo that does TurboTax. And I was one of those guys, I call myself out. I love to do my own taxes and see that number up the top go up and down based on what check boxes I clicked. But in that example, if you're going from 40% down to 20% in taxes on most of you guys are around $300,000, shoot, that's, I don't know, RV, you're the CPA. Normal tax bill for most people here is like 50 to 100 grand.
If your income is 1 million, 5 million, then that's fine. But if your income is 200,000 or 150,000 all in all, and you're paying 50 grand, then you need some strategy.
That's where people need to get off of the let me pay for TurboTax and do it the cheap way. That's penny smart, dollar dumb. Maybe people just need to do the math at home. If you can save 5% of your taxes, how much is that worth to you? And I think that would be at least to try it out for a year and go that way. But we'll close it with that. Thanks everybody for jumping on.